Pristine Collateral and the Future of Money, Why Gold and Bitcoin Stand Alone. Introduction. Throughout history, financial collapses have followed a predictable pattern. When assets are over-leveraged and used as collateral, they eventually become unstable, leading to systemic breakdowns. The collapse of mortgage-backed securities, MBS, in 2008, the financialization of privatized infrastructure in the UK, and now the rise of tokenized real-world assets, RWAs, all reveal the same fundamental weakness. When collateral is compromised, the pricing mechanism collapses and the financial system crumbles, leaving only the physical infrastructure intact. Yet, two assets have consistently resisted this fate: gold and Bitcoin. Unlike financialized assets, they do nothing but serve as money. They are not entangled in yield-bearing mechanisms, governance roles, or network utilities. This makes them pristine collateral, capable of withstanding financial crises and serving as the foundation for a resilient monetary system. 2. Historical lessons on collateral failures. The 2008 global financial crisis, the collapse of securitized collateral. One of the clearest examples of financialized collateral leading to collapse is the 2008 financial crisis. Mortgage-backed securities, MBS, were widely used as collateral in the U.S. economy. Banks, hedge funds, and financial institutions relied on them for liquidity, treating them as a stable asset class. However, subprime lending poisoned the collateral base. As homeowners defaulted en masse, the value of these securities collapsed. The entire financial system, which had been built upon these securitized mortgages, fell apart, leading to a global recession. The key takeaway: when collateral is compromised, the entire pricing mechanism fails and asset classes collapse. The infrastructure, homes, businesses, and physical assets, remained, but the financialized collateral backing them became worthless overnight. Privatization and over-leverage of infrastructure. A similar pattern has played out in the UK, where privatized infrastructure has suffered from excessive financialization. Utility companies, once stable state-owned entities, were privatized and sold off. Many were leveraged to the point of bankruptcy. The UK's water utility companies, particularly Thames Water, are now facing financial distress due to excessive debt. While the water infrastructure still exists, the financialized system that governs it is collapsing under the weight of over-leverage. The same fate has befallen railways, energy grids, and other essential infrastructure when their financialization leads to excessive debt. The physical infrastructure remains, but the financial mechanisms governing them become untenable. 3. The danger of tokenized RWAs and POS collateral. Tokenization of RWAs. Could this lead to the next mortgage-backed securities crisis? With blockchain technology, there is a push to tokenize real-world assets, RWAs. The idea is to create digital representations of real estate, commodities, bonds, and more, making them more liquid and accessible. However, this introduces the risk of global collateral contagion. Unlike past financial crises, where bad collateral was mostly contained within a region or sector, tokenized RWAs could expose the entire world to systemic failures instantly through global markets. If RWAs are poorly managed, over-leveraged, or mispriced, blockchain could amplify financial instability rather than mitigate it. The illusion of transparency does not eliminate the risks of financial engineering. Just as MBS were thought to be safe before 2008, tokenized RWAs could become the next major collapse if misused. Proof-of-stake tokens as money, a flawed idea. Some argue that proof-of-stake, POS tokens like Ethereum and Solana could serve as money. However, their very structure prevents them from being stable monetary assets. Unlike gold or Bitcoin, they are entangled with their network functions, staking, governance, and yield-bearing mechanisms. This creates an inherent vulnerability. They act as staking rewards, meaning they introduce inflationary pressures. They function as gas fees, meaning demand fluctuates based on network activity. They provide yield, meaning their monetary value is tied to speculative incentives. Once POS tokens become widely used as collateral in DeFi, they inherit the same fragility as MBS in 2008. If their value collapses due to a failure in the network or staking mechanisms, the entire financial ecosystem built upon them could face catastrophic failure. Collateral that is entangled with financial mechanisms is never pristine. It is always at risk of systemic collapse. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. I-4. Why gold and Bitcoin stand alone. Gold, the ultimate collateral in traditional finance. Gold has long served as the ultimate form of collateral in global finance. It has no counterparty risk, cannot be inflated, and does not rely on income streams. The United States has kept its 8,000-ton gold reserve untouched for decades. Why? Because in the event of a total financial collapse, gold can serve as a monetary reset button for the global economy. If it were revalued from its artificial accounting price of $42 per ounce to its market price of $2,800 plus per ounce, the U.S. could absorb enormous amounts of financial instability. This is why gold has endured as the world's reserve collateral for centuries. It is money, and it does nothing but be money. Bitcoin, the digital equivalent of gold. Bitcoin shares all of gold's monetary properties while improving on its portability and security. Unlike POS tokens, Bitcoin does not provide yield, does not require a staking mechanism, and does not serve any other function beyond being money. This is what makes it pristine collateral. It cannot be corrupted by financial engineering. With increasing global distrust in U.S. treasuries as risk-free collateral, especially after their weaponization against Russia, Bitcoin is emerging as an alternative. If sovereign nations and institutions begin accumulating Bitcoin as a reserve asset, it could become the world's digital monetary backbone, a collateral base that is transparent, unseizable, and resistant to financial manipulation. Conclusion. The best money does nothing but be money. When collateral becomes financialized, over-leveraged, or yield-bearing, it eventually collapses. Gold and Bitcoin are the only pristine forms of collateral immune to financial entanglements and systemic failures. If history repeats, financialized collateral systems will fail, while gold and Bitcoin will persist. The world is moving toward a future where trust in fiat-based collateral is declining. The next global financial reset will require a foundation of truly resilient money, and the only contenders for that role are gold and Bitcoin.